Hi, I'm Sam Gottlieb, Director of CFA Education here at UWorld. Today we're going to cover something really WACC, all right, but not that kind of WACC, okay, the actual WACC, or weighted average cost of capital. In this video, we're going to cover some of the most common mistakes involving WACC. Typically, users tend to trip up a little bit on things like the after-tax adjustments and the structure weights that they use in computing WACC. Now, WACC shows up in net present value, project evaluation, cost of capital. It's most likely on the exam that you're going to see this in the cost of capital portion of corporate finance. Corporate finance is about 8 to 12% of the exam. And nearly half of the candidates miss one of these types of questions. They're not conceptual failures, they're really just execution errors. So we're going to go through some of the tips and traps, and hopefully by the end of this, you're going to feel very confident about this. You're going to get to the exam, no mistakes on this, and you'll move on to the next one. Some of the most common ways that users trip up on WACC are shown here in these bottom 4 bullets. All right, so first, forgetting to adjust for the after-tax cost of debt rather than pre-tax. Using book values instead of market values when they're weighting debt and weighting equity. Using the current capital structure rather than the targeted capital structure. Now that one is a little bit ambiguous because sometimes they will explicitly tell you to use one or the other. But when there's no information given on that, you should either assume that what's given is the targeted or just explicitly use targeted if they give you both. And then finally, WACC is not a one-size-fits-all discount rate. You would use different weighted average cost of capital depending on the type of project. So the example that you could use is that Coca-Cola is very good at making very nice beverage. I drink a lot of it myself. All right, but if Coca-Cola decided they wanted to make electric cars, well, all right, that's something that's a lot riskier. It's really out of their sweet spot. If you as an analyst were determining what should I evaluate this electric car project from Coke, you would be using a much different WACC than if you were just evaluating their bread and butter business. There are 4 main areas where users get tripped up on WACC, and they're shown in these bullets at the bottom of this slide. So the first one is forgetting the tax shield on debt. Now, only debt gets tax adjustment. Why is this? Because interest is tax deductible. Dividends are not. Right? So if the pre-tax cost of debt is 6%, your tax rate is 30%, then the correct cost of debt is going to be 6% times 1 minus 30%, or 4.2%. All right, so using 6% instead of 4.2% as your cost of debt, it overstates WACC, understates your net present value. When you see a tax rate in a WACC problem, it is almost always going to be there for the pre-tax rate, and they will give you the tax rate, and you're going to have to make the adjustments, so don't trip up on that one. The next area where people tend to make mistakes is using the book value instead of the market value. Now, WACC is forward-looking. Book values are historical accounting numbers, so you're going to want to use the market value of equity, which is just the number of shares times the price. You're going to want to use the market value of debt, which is either the bond's market value or fair value. On the exam, that this is likely to be given to you. And you're going to only use book values if you're explicitly instructed to do so. If it's not specified, you default to the market values. Third area, ignoring the target capital structure. So if a firm provides a target capital structure, use it. WACC reflects the cost of new capital, not the historical mix. So if both current and target weights are given, you're going to use the target weights. Finally, applying firm-wide WACC to all projects. So WACC reflects the firm's average risk. If a project has different risk, like a different beta, different leverage, different industry exposure, you have to adjust your discount rate accordingly. So when you use firm-wide WACC, blindly against on all projects, it's going to distort the net present value, and it's going to lead to potentially incorrect accept or reject decisions. All right, so for the final exam checklist, right before you submit and go on to the next question. So a couple of things to think about in the exam before you submit the question and go on to the next one. If it's applicable, did you adjust the pre-tax cost of debt for the taxes? Did you use market values for your weights? Did you use the target structure if that is given? And is the project's risk consistent with the WACC that you're using? So if you incorporate those checks, you will eliminate most of the common errors on this topic, and it's easy points. Move on to the next one. Just be disciplined. So let's look at these a little bit more in depth. The first one, forgetting about the tax shield on debt. Here is the WACC formula. It's up here for a little bit of a refresher. The only one that you have to worry about is this pre-tax cost of debt. Only debt gets tax adjustment. Only debt is adjusted for taxes. And why is this? Well, because interest is tax deductible, dividends or not. They're not on common stock, not on preferred stock. So as I said previously, if you're using the wrong cost of debt, you could be passing up on a great project because your discount rate is wrong. Remember, again, it's like I've said it before, it bears repeating. When you see a tax rate in a WACC problem, it is going to almost always be there for the pre-tax cost, and then you need to make the adjustment for tax. Now, if there's no information about taxes given in the problem, then you can assume that that cost is the after-tax cost and just go ahead and use that. So the next trap is using book values instead of market values. Again, WACC is forward-looking. Book values are historical, right? We want to use something that's going to tell us what will happen rather than what did happen. Like I said before, you're always going to use the after-tax cost of debt. And here it says before tax cost of equity and preferred stock. I mean, yes, that is technically true, but there is no adjustment for taxes on equity, either common or preferred. So do not go ahead and adjust for after-tax cost of equity because, again, you'll get a wrong number. You're going to use the market value of equity, all right, and this is just going to be the shares times price, and that'll give you the market value. And then the market value of bonds, right, either the bond value, which will be given to you, or the fair value. And again, the fair value will be given to you. Now, in theory, you could calculate all of these values, but remember that each question is designed so that you'll have 90 seconds. So if you have to do a bunch of calculations, then it makes it a little bit unfair. And the CFA Institute, it's a hard exam for sure, all right? You need to study for it, but it's a fair exam. They're not going to do things that are just deliberately going to make you waste a lot of time. So they will lay out most of the information that you need, but it's up to you to figure out how you use it, all right? And that's just about studying and drilling and making sure you're comfortable with the concepts. So another trap that could crop up is using the current weights versus the target weights. Again, the weighted average cost of capital is the cost of new capital. So the firm is raising additional capital either through debt or through equity or some combination of both. So we want to know, it's like, what's the cost on that? And as an aside, when you're talking about cost of debt, it's like, what is that? Well, it's like, well, the cost of debt is basically the return that investors want to invest in lending to you. And equity, it's the cost or the expected return for what investors expect from investing in common stock or preferred stock. I mean, that's a simplified way of looking at a topic that can actually get kind of complicated. But in terms of just looking at the symmetry, that's really where those terms derive from. So when we're looking at raising new capital, we basically are asking, well, what do investors expect if they're going to lend to us or if they're going to invest in our common stock? So again, if you are given both the current and the target structure, you're going to use the target weights. I also don't think that this is something that's going to come up very often, if at all, in the exam. It's really more of a level 2 concept where they get into it in much more depth. I think they just kind of allude to it, that it's something you do need to be aware of at level 1 when you're looking at determining what WACC is. So if a project has a different risk, maybe a different beta, different leverage, different industry exposure, then you have to adjust the discount rate. If you just use WACC blindly and assume it's a one-size-fits-all proposition, that's often going to distort the net present value. It's going to lead to some incorrect accept or reject decisions. So let's do a practice problem. In this one, we're told that the WACC of this company is 9.35%. That's a little bit different. It inverts what they normally do, which is they give you the inputs and ask you to calculate WACC. In this case, you're given WACC, and they're going to want you to calculate the cost of one of the components. So let's look on. Our tax rate is 32%. We're told that the capital structure is 35, 25, 40 for debt, and our preferred, and our common equity. All right, so those are given in percentages. We're told that the cost of common equity is 11% and that the preferred equity cost is 6.5%. What they want you to do is calculate the pre-tax cost of debt. Well, in this case, it's exactly what you would do if you were calculating WACC, but you're just starting with WACC being known. So we know that our WACC is 9.35%, and that is equal to 35% of the weight of debt. All right, so our pre-tax cost of debt is the RD, and then we are told that the tax rate is 32%. So to get to the after-tax cost, we're going to multiply that by 1 minus 32%. Then we're going to add in the cost of our preferred equity. So we have 25% of preferred equity at a cost of 6.5%. And we're given that the cost of common equity is 11%, and that comprises 40% of our capital structure. So basically what we want to do is isolate this. That's the debt component. So 9.35% minus 25% times 6.5% plus 40% times 11%. So that gives us a total of 3.325%. Now, the next step is we need to simplify for our cost of debt. So we know that debt is 35% of our capital mix, so we would just divide that 3.325% by 35%. And that gives us 9.5%. That represents the after-tax cost of our debt. So to get to the pre-tax cost, we would just take that 9.5% and divide it by 1 minus 32%, or 68%. And that gives us a number of about 13.97%. And the closest number to that is 14%, so that A is going to be our correct choice. Let's do another practice question. Now this one is sneaky, but it's a fair question and it may show up in some form on the exam, so be ready for it. Most people who get this type of question wrong assume that the debt to equity ratio, which you need to know for this problem, represents the weight of debt in the capital structure. All right? It does not. What the debt to ratio does do is give you the amount of debt for every $1 in equity. So as an example, if you had a company with a debt to equity ratio of 1, that means that the capital structure is $1 of debt and $1 of equity, right? So that gives you that 1-to-1 ratio. However, the total amount of capital is $2. So in this case, debt would be 50% of that capital structure, and equity would be the other 50%, all right? So the weight would be 50%, not 100% debt. So in this problem, what you are required to do is to calculate the WACC. And you notice here that you're given both the book value and the market value. And remember that when you're given both of them, you want to use the market value for this. You're also told that in this case, the firm's cost of equity is 11% and the cost of debt is 7%. So what you want to do here in this case is that they give you these three companies as comparables, and they're asking you to calculate the WACC based on the debt to equity ratio average for these three comparable companies. All right. So rather than make you suffer through my chicken scratch of writing this, we have gone ahead and put the answer up in a way that you can read it a little bit better. So again, the average debt to equity is going to be equal to the averages for each of the companies, all right? So 0.6, 0.2, 0.3, and you'll divide that by 3. So the average debt to equity is 0.367, all right? That is not the weight of debt. All right, the weight of debt is given in the next one. Again, it's doing nothing more than what I had gone through before, all right? But the weight of equity, but the debt to equity ratio represents the amount of debt for every $1 of equity, right? So you have 0.367 in debt, you're going to add 1 to that, and so that's going to give you your total average capital for these three companies of 1.37. So 0.37 divided by 1.37, this is your debt weight right here. And then the weight of equity is just 1 minus the weight of debt. Remember, no preferred stock in this case, so that makes it simpler. And it turns out that your weight of equity is 0.73. And at that point, you now have your weights for debt and for equity. They're already on an after-tax basis for the debt. So all you do is just put in the WACC formula, input the numbers, and crunch away. And at the end of that, you end up with a WACC of about 9.93%. Now, I would try to do a few practice problems on that because, like I said, this is something that could come up on the exam. You want to be ready for it so that when you see it on the exam, you don't just automatically go to, oh, debt to equity is 0.5, so therefore my weight of debt is 0.5. Nope. And I guarantee you that there will be an answer choice that would be correct if, in fact, the weight of debt was 50%. All right, so don't make that mistake. Easy points, check it, and move on. So that brings us basically to the end of this. Just want to give you just some takeaways of it. First of all, make sure that you're going to use the after-tax cost of debt, not the pre-tax cost. Second, when given, you're going to want to use market values and target weights for the capital components. And then finally, you're going to use the appropriate WACC. Now, project WACC, it says here, it has to reflect the risk of the project, right? Not the firm's average cost. If you do have a question that comes up for that last matching the risk to the rate, they will explicitly tell you that this is a riskier project and that your cost of equity, for instance, would be a much different number than the firm's normal cost of equity. And so you would plug that into the WACC formula rather than the average cost. Finally, give you a quick mnemonic. Some people find mnemonics to be useful, others maybe not so much, but we offer it here. Target, all right, so the T is for the taxes on debt. The A talks about the after-tax adjustment. R is risk match, right? So use the appropriate WACC depending on the project that's being considered. G is go with the market weights. The equity is a before tax basis. And then T is that total capital blend. So from the debt to equity, you have to figure out what your total capital is before you can start determining what the weights of debt and the weight of equity are. Okay, that is going to be, as they say in the biz, a wrap. And I'm very happy that you were able to join me here with this today. I wish you the best of success on the exam. But I have been doing this long enough to know that luck is not a piece of this. Preparation is. And for any kind of test like this, that's a real simple proposition. If you study, you pass. Get to studying. We'll see you at level 2.